Welcome, ladies and gentlemen, to our virtual roadshow session here today with Adventus Mining. And with us here is Christian Kargl-Simard, the CEO of the company. Welcome and good morning, Christian. How are you?
I'm well. How are you, Jochen?
Super, perfect. Thank you very much. All good. We have already attendees here checking in. And let me do some remarks before we start, please. First of all, as you know me all, my name is Jochen Steiger. I'm the CEO and founder of Swiss Resource Capital AG and also the founder and chief editor of Commodity-TV and Rohstoff-TV. Yeah, we are doing this virtual roadshows, of course, to date you up, and there's a lot going on with Adventus Mining. But before we start the presentation, please be advised, nobody can see each other, nobody can see any names nor emails. Please use the chat function for posing any questions, because we will do 20-25 minutes presentation. Afterwards, the Q&A, and we are, of course, fully complying to the data security laws to Europe, Switzerland, and Great Britain. Yeah, so let me see. The attendees, are coming in. Perfect. Let's give them another 10 seconds here. And takes a little bit longer today. Maybe we have a little bit of a longer line, but that is going fine. Okay, so let me bring up your presentation, and I would suggest, Christian, the floor is yours.
Thank you, Jochen. So this presentation is also on our website, adventusmining.com, and it is our new presentation since the publishing of our eagerly awaited feasibility study. So as the title of the presentation says, Kargl-Simard building the next major mine in Ecuador. So we believe we're next. We're the next one after Lundin Gold's Fruta Norte. This is probably the only mine that will be built during the current President Lasso's government. And we are charging full speed ahead to be in full-scale construction by the end of next year. Some forward-looking statements here. I'll let you read this at your leisure. So right into the highlights of the feasibility study. So our project is the highest rate of return copper development project in the world. And that is driven by the very high grades, as I think most of your listeners understand. The project is split up into two, open pit and underground. The open pit is the first 10 years of the mine life. That was done to NI 43-101 feasibility study status with maiden reserves, and that showed a 259 million US NPV8 using long-term pricing. We have an underground component that goes from years 11 to 15. That was on the basis of an updated PEA, and that 49 million NPV8 is discounted from the start of construction of the open pit. So even though production only starts in year 10, or actually 12, if you look at the construction period, that has a value of 49 million US. So you can add the two together to make it a 308 million NPV8, and you compare that to the PEA done in the summer of 2019 that showed a combined 288 million NPV8. The biggest upside to the project with the current resources and reserves is accelerating the development of the underground earlier in the mine life in tandem with open pit, and you could see potential tripling or quadrupling of that NPV by doing that. The open pit alone has an IRR at long-term prices of 32%, using spot pricing 44% after tax, a good ratio of NPV8 to Capex, making it financeable as a junior company like Adventus. The most attractive features, though, are the cost profile. The Capex covers a large tailings dam, which is good for the entire life of mine. Both the open pit underground covers any new discoveries. So there's higher Capex up front, but that covers most of the sustaining Capex over the life of mine. What you're looking at, if your viewers are more familiar with gold projects, is 92,000 ounces of gold equivalent a year for the life of mine, at an all-in sustaining cost of $308 per ounce gold equivalent. I'm not aware of a mine in the world, in the gold space, that's operating at that low of an all-in sustaining cost. So this will generate a lot of free cash flow that will allow us to explore more in the district, maybe expand production, bring up that underground, and also build our platform in Ecuador. What is that platform right now? It's 3 projects with over 25 VMS and porphyry exploration targets that have yet to be explored. If you look at a production profile like this, say 92,000 ounces of gold equivalent a year at say $600 or $700 all-in sustaining costs, that would be equivalent to say a West Dome listed in Canada. That's a $1.5 billion market cap company versus our Adventus at currently 120 million Canadian market cap. This shows you the life of mine free cash flow profile. You're looking at around 650 million US of free cash flow using long-term pricing. If your readers are familiar with Silvercrest Metals, that life of mine free cash flow is just slightly higher than this using the same price deck, and that is over $1 billion market cap. So yes, it's a precious metals company, but there's a lot of precious metals in this project. And should the market really be discounting us so much because we're a base metal developer in Ecuador? We used top consultants for volcanic massive sulfide project in Ecuador. So these are consultants that have permitted or built mines in Ecuador, and or groups that have best-in-class experience with volcanic massive sulfide deposits. As many of your viewers will know, this is an earn-in deal with Salazar Resources. So over the last 4 years, we spent 48 million US to deliver this feasibility study. We will be delivering an environmental report next week. So you can actually put a price tag or price to net asset value that we paid for this 75% interest in the project. And it's around 0.2 times, which is pretty reasonable in the context of the market. We announced in that feasibility study that we are well down the track on arranging $240 million in non-equity financing for a project versus a capital cost of $250 million. So as a potential investor, you have to ask yourself, is $250 million financeable for a company like Adventus? Well, I'm saying we've got $240 million lined up of non-equity. Can we arrange 10, 20, $30 million of equity in the market? Absolutely. Our last equity financing was $38 million at $1.27 a share. So for those that are worried about equity dilution, they shouldn't be. There is going to be some, but it is very limited. And this is a project with very high margins, so that can be geared substantially to get into production quickly. ESG-wise, we are connected to the hydroelectric grid, or the grid in Ecuador, which is primarily hydroelectric. We have a small footprint of a mine because of the very high grades. We are nearby the major deep water port, so not significant fossil fuels burn for transportation. We are one of the largest, if not largest, foreign direct investment projects in Ecuador, so a top priority for the government. And we have done several consultation processes with our local communities ahead of the submittal of the environmental social impact assessment. The main priorities of the communities are number 1, jobs, number 2, jobs, number 3, water, and everything to do with water, tailings, waste rock, etc. have been done to the highest Canadian standards. A reminder on our cap structure, 131 million shares out. We're currently trading around $1 Canadian a share, just under, giving about 130 million Canadian market cap. We have, as our last quarterly financials, 20 million in cash. So this is all drives an enterprise value in the 100 to 120 million Canadian range versus an NPV8 after tax on a 100% basis using long-term prices of 308 million US. We're a top developer pick of several of the banks. Just the other day, PI Financial launched coverage on us with a $1.80 Canadian target price. Most of the target prices are in that $1.80, $1.90 average versus our current Canadian $1 share price, which is based solely or mostly on the Curipamba project without giving much value to the exploration upside. We have a unique shareholder base for a base metal developer. We've raised 100 million Canadian in equity over the last 4 years. That would be one of the largest equity fundraising for any base metal developers in the world. So what would be more is Solaris, SolGold, and maybe one or two other companies. A lot of that's been driven by a very strong institutional shareholder base. We have over 30 around the world, plus a large strategic shareholder base. And many of these investors are there to pony up for the final equity to build this mine. Nobis, this was probably one of the best things we've done as a company, bringing on them as a major shareholder. They're the largest industrial conglomerate in Ecuador. They're a political risk insurance, very motivated to see this mine getting built. This is their only mining investment. They're learning about mining through us. They continue to buy in the market. They bought 3 million shares in the month of August in the market, and have very good relationships with government that augment our very strong relationships we have through the Salazars and through our country manager. Our management board are well known in the mining sector. We have a plan to significantly build this management team to construct a project. So we've selected key construction building people to come into the company in the first quarter of next year. So with the publishing of the feasibility study, we announced our maiden reserves, 6.5 million tons, 50% of that in a proven category, which you rarely see, at 1.93% copper, 0.2% lead, 2.5% zinc, 2.5 grams gold, 46 grams silver, with a 6-to-1 strip ratio, and the majority of those reserves 40 to 80 meters below surface. Very, very solid. That really maximizes the open pit. The upside on the El Domo deposit comes through the underground. So in the updated PEA, you saw 2.7 million tons, primarily in the indicated category, and there's potentially another upside from there of another 1 million tons through exploration potential. We just got upgraded our mining permit to medium scale status, which allows us to submit our ESIA, and a reminder that we have acquired all the key surface rights to build a mine, and we already have pretty good infrastructure where our project is. Our deal with Salazar Resources, now that we have completed the task for earn-in, is we must fund 100% of the capital cost to go to commercial production. Because we're doing this, we have 100% of the offtake rates of the project, and we have the right to encumber 100% of the asset with streaming or debt transactions. Once we get to commercial production, we receive 95% of the free cash flow until all of our investment in the project is repaid since October 2017, net of $19.8 million US, which is what the Salazars had spent in the project prior to involvement. After that time, then the cash flow splits 75-25. So it is preferential payback as a result of us financing 100%, or being responsible for arranging finance for 100% of the project. The biggest advances since the PEA, a very solid reserve, 50% of it being proven. As mentioned, you really never see that for projects. Most projects, especially for junior companies, are all in the probable category. We have maximized the metallurgical recoveries, the grades of the concentrates here in the feasibility study, which is a real strength of the project at this point. We have improved optionality to underground. We've changed the mining method to drift and fill from room and pillar. We have spent $5 million doing the baseline studies and preparing the environmental assessment package to be submitted shortly. And then best-in-class technologies around waste, tailings, and water. This is a neat slide showing the year-over-year metal mix between the copper, gold, zinc, silver. If you look at the open pit, we're around 50% copper revenues, around 28% gold revenues, 15% zinc revenues, 7% silver, and less than 1% lead. So this is a copper gold project. Some of the comps in the market are more silver zinc or silver gold. There's very few that have this kind of metal mix and are at this stage, especially in a junior company which has the means to develop this project on its own. You can see the metal grade. We're starting at 7% copper equivalent open pit, and then running about 5% copper equivalent over the life of mine. For some people, the capital cost increase since the PEA was a surprise. Keep in mind, it's been over 2 years, almost 2.5 years since the PEA was completed. We went straight from a PEA to the feasibility study, and the main changes in capital costs have been driven by geotechnical drilling. You don't do geotechnical drilling in a PEA. Some companies don't even do geotechnical drilling in the feasibility study, but it's the main reason why capital costs blow out on projects. And if you look at the mining here, $33 million more for mining. This was mainly driven by the need for mining more fresh rock or andesite materials to build our tailings dam. In the PEA, we assumed overburden on top of the pit. All that material could be used for construction of the tailings dam. None of it can. So we have to access more fresh rock, which we're mining anyways through the stripping over the life of mine. In the feasibility study, we're moving that stripping up to initial capital, which is also then reducing our sustaining capital for the life of mine. Earthworks, that's through better definition of the topography, but also through things like the process plant was sitting on the top of a mountain. We got to now move more material to get to fresh rock because of the geotechnical drilling to have a better foundation for the process plant. Process plant increase would be a larger throughput, would also mean connection to the electrical grid. So in the PEA, we assumed a startup on diesel power. Contractor indirect. So this is looking to the details of cranes, the cranes you need for construction. Are they available in Ecuador? If they're not available, what's the cost to bring them in? The cost for the contractors to set it up, where are they going to stay, those kind of things. And on the plus side, the majority of these capital costs are done with live quotes from contractors in Ecuador. So this is up to date from the last couple of months. That has given DRA the confidence to do a plus or minus 10% on the capital costs. We've talked about the highlights of the feasibility study using long-term and spot pricing. Just a reminder to your viewers, we have a conventional process plant, no new technologies. This is meant to be simple to build, simple to operate, and we produce very clean concentrates, 28% copper con with very good precious metals credits, 56% zinc con with good precious metals credit, and a minor lead concentrate. This is an interesting slide that National Bank put together. This is looking at all of the copper projects they've ever looked at in the history of the world, and where does our project stack up? And it is ranked by after-tax rate of return. So this is showing we are a top 5 project of all time with regards to after-tax rate of return for a copper project. NPV and IRR upside. So this is just looking at the 9.2 million tons that is in the reserves and underground resource of our latest study, and where are ways to improve the project. We see a path of taking that 308 million US to north of 400 million through the following ways. Number one, accelerating the underground development. So that's currently in year 10. Underground material is very economic. We would look to increase the size of the process plant funded through cash flow and bring that underground into years 3 or 4 of the mine plan. That in itself can increase the NPV by well north of 50 million US, potentially 100 million US. And the reason the likelihood is high is because it's there, and you just would do it because of the time value of money. We don't want to fund it with the current treasury right now, because where we're currently trading, that's not the best use of our capital, but we'll be doing it out of cash flow out of year 1. Infill drilling may increase the underground grades. When we infill drilled open pit, we got a bump up on grades. We would expect something similar when we infilled underground. Reduction of VAT, we're currently, so VAT is the value added tax. We're currently negotiating an investment agreement with the government of Ecuador. We have asked for a reduction from the 25 million in VAT. We would expect perhaps to cut that in half, which immediately drops the capital costs by whatever we can reduce. Tailing storage design or optimization, we have a project underway already now, which potentially could reduce the capital costs by 10 to 20 million on that front. And then it's the other aspects are accelerating the ESIA approval, potentially getting to production quicker, and an installation, which we would plan to do through cash flow, of an additional process step to improve gold and silver recoveries. So our timeline is we're assuming the base case approval of our ESIA, call it October of next year, detailed engineering starting Q1, completing by the end of next year, announcing 1 to 2 project finance packages in January. We mentioned the investor agreement that's underway, starting early site works in the second quarter of next year, starting full-scale construction in the fourth quarter of 2022, with commissioning in the second quarter of 2024. There's probably a plus or minus a quarter that we can work with here, but this is a plan that DRA or contractors also signed off on. I was recently in Ecuador with the Salazars, meeting with the president and the key ministers. We have very strong support for our project, especially since this, as I mentioned before, this is probably the only mining project that can be in production under his term. Regional exploration. So we've continued to drill around our Agua Santa discovery. We will have an update with additional drill results later this month. But we just are scratching the surface on regional exploration, with the stars indicating 14 undrilled geophysical targets. And a reminder, our Agua Santa discovery, which we announced late July, is 4.5 kilometers southwest of El Domo. We drilled 6.3 meters of 5.5% copper equivalent. Then we have our Santiago and Pijili porphyry projects, big upside, billion-ton potential. At Pijili, we made 2 new discoveries in the last year. That's on the first of multiple porphyry targets in the district. We are excited to announce later this month a drill-ready new target. It's very exciting, called Pato, which we hope to be drilling next year. And then Santiago, many of the listeners are waiting anxiously for us to be drilling there. We had a drill rig on the project in August. We had to remove the drill rig as there were still some issues with protests and external people from the project coming in and creating issues. We've gone back with the highest level of the indigenous leadership in Ecuador and the government to come back and support us to potentially be drilling here in January. So we have ring-fenced $1.5 million US in our treasury to drill the 3,000 meters, but currently we're planning to do that in the first quarter of next year. A reminder on our Pijili district, so we're in southwestern Ecuador. Southern Copper has a major porphyry project in feasibility study. We have been building a land package around Southern Copper in the blue and purple boxes. Our 2 new discoveries were at the Mercy concession in the last year. Our new Pato target is 7 kilometers to the west of Mercy, here with this star, within our Carmen de Pijili and Rosa de Oro concessions. And we plan to do a 2,000 to 2,500 meter drill program in the first half of next year on that project. More details to come. Our Santiago project is our flagship exploration project. We have the historical drilling from Newmont Shallow, with these drill holes shown here at surface, with some great results in the bottom right table. These were drilled 1993 to 1995. We have the results of our airborne survey from the last few years, showing this big wine glass shaped maglow sitting right underneath the historical drilling, which will indicate that this is a deep-seated porphyry system, probably mineralized to depth, hopefully higher grade than that surface. And that's why we're excited about drilling these 3 1-kilometer plus holes, partially twinning the historical Newmont holes, but going down deep and testing this geophysical target. This is one of the best targets I've seen anywhere in the world. We're fully permitted to drill here. Now it's just getting the right security situation for the project. And while we've done a great job with the local communities, what we cannot control is external protests and marches from people that have nothing to do with this project. And that's where we need to have the support of the government and the broad countrywide Indigenous leadership support as well. So to conclude, as not a surprise, I think, to your listeners and investors, we have come out with a peer-leading feasibility study on a copper gold project. This is a real project. We're planning to build this starting at the end of next year. We're deep into the final discussions to complete our financing packages. We're about to submit the ESIA, with it being the key project in the government queue for approval, hopefully in the summer of next year. And once these financing packages are announced in January, we will commence on the detail engineering. We have very strong exploration upside around all three of our projects. We hope to have a modest exploration program during construction around these three projects, but in particular, get that drilling going on Santiago in the first quarter. We also have M&A interest in the company. It wouldn't be a surprise that we have that, and this project fits well with several producing companies where this would be the next mine to be built. They have construction teams, they've got good access to low cost capital, they've got experience in South America, so it could be a nice bolt-on to a producer. And so those discussions are happening in parallel with the project financing, with an outcome to happen over the next few months. We expect to announce here shortly the start of drilling on some new targets by South32 in Ireland. This reminder is a 70-30 joint venture between South32 and Adventus, with South32 funding the next few years of exploration drilling. And I'm just about to get in the road here starting next week after the submission of the ESIA on a 3-week global roadshow, which will probably see us talking to 50 to 70 institutions, giving a similar update as you've heard today. Back to you, Jochen.
Thank you very much, Christian. Great presentation. Let me stop this here. And let me go here to the chat function. All right. Yeah, first of all, question from my side. To be honest, I have the feeling that your share price is way too low. Yeah, I'm a shareholder of your company. I should disclose that also. And I think what we have seen now with your presentation, your stock price should be already at 150, I think. Yeah, just from the valuation side you have with $20 million in cash, this is really outstanding. So what do you think might be the reasons? Is it, let's say, the higher Capex? Is it Ecuador by itself? Why do you think that the stock held back a little bit in the last months?
Well, if you look at the target prices of the 6 analysts that cover us, as I mentioned before, they range from 160 on the low end to 250 on the high end, called the average of 180 or 190, which is primarily driven by Curipamba. So I think $1.50 is probably not a bad assessment, especially for a high-grade, unique copper development project. Mm-hmm. So why are we trading at these levels? I think it's a combination of Ecuador. I think it's a combination of people are worried an equity financing is coming, and so further dilution, or they're waiting to participate in equity financing and rather not buy in the market.
You mean in the cheap one?
Yeah, looking for a cheap one, and my goal is to make sure there isn't a cheap one. And then there is an expectation on exploration. I mean, the most exciting stories in the market today are exploration-focused stories. The market, though, does not seem to understand the time value of money. Some of these stories have fantastic discoveries, maybe billion-dollar plus market caps, but they won't be in production for 10 to 15 years. It's going to cost them billions of dollars to get to production. And when you discount that back to today, the NPVs of those companies are significantly lower than where they're trading today. Whereas with Adventus, this is a real timeline to development that we're showing with this feasibility study. Mm-hmm. So yeah, big disconnect there. We're not in a market where people are valuing those smaller to mid-tier projects that have a real timeline to development. People are more wowed by production or through exploration success. That's where the Santiago project would come in perfectly right now. And we've had to deal with, not because of lack of trying, but deal with certain external issues that we're working through. We made 3 new discoveries, though, over the last year: porphyry, a VMS, and a skarn, and the market has yawned. So that tells me that the main driver of the company here is what we do at El Domo, how we develop it, how we finance it, what are the next steps. The next steps to me, which is what everyone's waiting for, is the financing package and or the sale of the company.
Okay, sale of the company, we come back onto that in a minute, but there's also several questions popped up here while you were talking about, do you think also maybe the political situation is something which depressed the share price a bit, given the situation Ecuador, Peru, Chile, to say it very caution, let's say the elections were a little bit more to the left side?
The simple answer to it is, does the political situation affect Solaris's share price at 1.5 billion market cap, SolGold share price at 1.2 billion, Filo Mining in Argentina at over $1 billion? No. So it's somewhat of an excuse to say that, oh, there's a political overhang. Ecuador has had more investment in exploration development over the last few years than any other country in South America from a public markets perspective. It's wide open. I don't get institutional investors talking about Ecuador political risk. And if there was risk, we have the best relationships with government of any of the companies working in Ecuador, other than maybe Lundin Gold. So we have that political risk insurance with Novus, with our Salazar relationship. All of our employees are Ecuadorian. We have significant Ecuadorian capital in this story. So it's not political, in my view. And we have the best president under Lasso in the history of the country to be building a mine in, with as I mentioned, my meeting with Lasso recently. So if people are concerned about the political aspects, I think we have them well covered.
Okay, then let's talk for a second about a possible takeover bid. I mean, this is something which really comes to me up here. As I said, I'm a shareholder of your company, and I'm also speculating a little bit onto that, because I think you are way too cheap, as we spoke about already. And could it be that you say, okay, you know what, we are selling Curipamba, let those guys bring this into production, we take a nice amount of money for our shareholders, but we keep, for example, Santiago, Pijili, Mercy, and also, of course, the Ireland South 32 joint venture, and bring this into a new company, and then we move forward? Is that an option you could consider, or to sell the whole thing?
I don't want to confuse listeners here. Are we building versus we're selling? I want to make it clear that the status quo in this company is we're building it. I have a handshake with the president on our expectations to build this under his presidency. I'll deliver the money, you deliver the permits, we're going to build this thing. You cannot run a company on the basis of hoping for an M&A transaction. If you do good work, if you got a solid project, M&A will come. The commentary about M&A is meant to be a broad-based comment that there are those discussions happening. It is a possibility. And the right time to be doing something from an M&A perspective is probably over the next 3, 4, 5 months. Once you've fully financed the project or you're in construction, you're going to see it through. You're going to see it through to commercial production, and perhaps you get, after a re-rate, after getting in production, M&A is back on the table. But if you have a company that wants to use their capital, their know-how, maybe change some designs, etc., now is the time to come in. And in terms of the type of transaction, we see people interested in everything. But in general, we see people interested in Curipamba. So they'd be acquiring Curipamba, and we'd be spinning out the other assets into a new company.
Okay, then let's talk about your financing. You said you lined up already $240 million without any dilution. We saw Wheaton as one of your large shareholders. So might there be a stream involved? Do you do any forward sales? Do you base this only on credit lines? Can you say already something if it's that non-dilutive?
Well, all of the above is on the table. The value of the concentrate, because it's really good quality, and there's tons of competition. The value of the concentrate has been a surprise to me in terms of, first of all, the amount of interest, but also the financing options that have come out of that. So we have multiple groups, the largest groups in the world, where we're offering life of mine offtake, but they're offering us between $50 to $85 million as a combination of a concentrate prepay, which is generally subordinated, and some equity. So that's one bucket. With Wheaton, you can assume that they're interested in a stream. This is textbook streaming. They're a major shareholder, and then there's debt. There's the debt capacity of the project. The one thing I should say is that the country credit ratings have deteriorated over the last few years. Even though Lundin Gold has had great success and it's become a mining country, access to bank debt is almost impossible and is definitely way too risky for junior companies. So what is available on the table is private equity money, private debt funds, bespoke debt funds, streaming off-takers. And we've been working on this now for several years to evaluate all the different options. And I think we have one of the most attractive project financing packages on as a whole that I've ever seen for a single asset developer.
Let's talk shortly about the Capex, because I'm not sure if I saw any contingencies in those 250 million you need.
Yes, contingencies in there. That was that last line item where, say, it was a bonus that DRA was happy to go down to a 10% contingency for the feasibility study. A lot of the feasibility studies are 15. That 248 includes the 10% contingency, includes the $25 million in value-added tax, which has doubled since the PEA. As I suggested, we think we can take off perhaps 12 million through the value-added tax that we're negotiating with the government right now, and we think we maybe can find another $10 million or so of savings, maybe a little bit more from the tailings. So that's upside, but probably get some capital creep elsewhere. So 248, I think, is a pretty solid number.
You said in your presentation also that let's say mining costs increased by 33 million because you could not use the overburden to build the tailings dams, and now you have to mine more fresh rock. Wouldn't that mean on the other side, when you have to mine more fresh rock, that you have maybe not only fresh rock but also mineable ore in that, so which you can sell?
Okay, let me explain that in more detail. So in the PEA, we assumed moving of approximately 4 million tons of pre-strip to build a tailings dam. The rest is just material that you just scrape off the surface. A lot of it is what we call tooth material. Through the geotechnical drilling, we determined that that is not suitable material for tailings construction. In the PEA life of mine, as we were stripping the ore body, you were mining andesite or fresh rock that you were just putting on a waste pile. That was captured as sustaining capital. In this iteration of, or in this feasibility study, we need to move 15 million tons of pre-strip material to build a tailings dam, most of it being andesite. And so what we've done is we've taken that andesite that was in the stripping over the life of mine in the PEA and moved it up as initial capex to build a tailings dam. which has had the effect of reducing our sustaining capital compared to the PEA in the feasibility study. Does that make sense?
Mm-hmm.
Okay.
Okay, super. I saw in your presentation also that the AISC in the feasibility study were $1.26 per pound of copper equivalent, I think it was. And by October 21st, it was 141. Is this a function of, let's say, the inflation we saw the last year,
No,
1.5 years?
That's purely to do with different price deck and how equivalencies work.
Mm-hmm. Okay. Super, perfect. So then let me see here. What is your opinion on the current status of the battery metal sector, and where do you see your commodities you will produce in 4 to 5 years?
We are perhaps at the start of the most significant bull run for commodities the history of the world has ever seen, and that is really driven by partly money printing, partly COVID related stimulus, but really about governments using COVID as an excuse to set the course for, I'm going to say, a battery metals revolution, moving from fossil fuels to a more metals driven world to decarbonize the world. The requirements for metals to do that are unbelievable, and it's actually impossible to do, in my opinion. But every way you look at it, it's going to mean more demand for things like copper, cobalt, lithium, nickel, and the list goes on. You got to include everything, because you build a wind farm, you need iron ore as well, etc. So I'm most constructive on copper, because everything to do with electrification has a component of copper, or higher copper intensity than is required today for conventional vehicles, etc. Copper is 50% of the project. I see gold and silver as a natural hedge towards the base metals on our project. It also provides perhaps flexibility from a financing perspective. And zinc is 15% of the revenues, but it's super clean concentrate. I have mixed views on zinc going forward, but it's not a bad thing to have diversification. I mean, right now, zinc's $1.50 per pound. It would be a massive credit for the project.
Okay, and where do you see the metal prices, let's say, in 4 to 5 years? I think that was a bit the question. Okay. What is your feeling? I mean, bull run, we are totally on one line here, that's for sure. For example, my target is $7 for copper within the next 3 years, just to give you an idea per pound.
Copper prices, I think, have a chance to be $10 a pound over the next 10 years. We are having disruptive technology, a disruptive event with what we're trying to do with the climate change push and metals, in particular copper. So that's going to be the main driver. But then you got inflation, but also geological inflation. So copper grades continue to go down. So you have to build bigger mines on lower grades. It's just a snowball effect. So I think we'll hit all-time highs for copper again next year, and the incentive price to build new copper mines will continue to go higher. I don't think copper prices will be below $4 a pound for material lengths of time unless we have a big global pullback of some sort. I think your number $7 per pound is pretty reasonable.
Okay, thank you. Like to hear that. We saw on your slide about the capital structure of the company that the management holds 8%. Then you have Wheaton, Nobis, I think Greenland is the other company on board. So altogether, you are easily controlling with your largest shareholders together. You have like, I think 40 to 50% together, if I calculated that correct. Are your largest shareholders fully aligned with management's thinking?
It's a great question. I am honest to tell all of the viewers here that All of our decisions to date, we have had full alignment between all stakeholders. Been a bunch of work, but I keep everyone informed, and they've been big supporters of what management and board has done. So alignment has been great.
Super. Then you have $20 million in cash. I think you said already that this is enough to bring you through until project finance, stuff like this. But I saw also 5.7 million options. What is the strike price there? What are maturities? Just to give us an orientation.
Yeah. So that was 20 million Canadian as of second quarter. As of today, we have about 8 million US. So say that's 11, 12 million Canadian. That's sufficient to take us to April of next year. By then, we should have either sold the company or executed on the project financing packages, which will have brought additional capital in to the company and satisfied all or most of our financing needs for next year without the need for a public markets financing. Doesn't mean we won't do one next year, but we're definitely don't want to be doing it at current prices. On the option side of things, so this is I think unique as well for your viewers. The average price of all the trades of Adventus since it was started is about 95 cents to $1, exactly where we're trading today. Nobody has cheap paper in this company. The average price of the options that you mentioned, I believe, is 96 cents. So there's that's why if you look at the share chart, when you get to around 90 cents, it's a pretty strong floor. And the average price of like Wheaton, for example, is over $1. Of Novus is around 93 cents. So unless someone is desperate to get out and wants to drive the price down below 90 cents and take a loss, everyone here is at kind of basement price.
Okay, super. So let me check this here. That looks all good. We have done that. That is also fine. Then also from my side. One question. How many jobs would the mine construction create directly and indirectly? Meaning, how important is your mine, let's say, for the community and for the surrounded area?
800 jobs during construction, over 80% direct jobs, over 80% Ecuadorian, 300 jobs during production, over 90% Ecuadorian. And mining has a 3 to 4 times multiplier effect from there. It is by far the largest, currently largest employer in our province, let alone canton, and will get even larger. This is one of the largest foreign direct investment projects in Ecuador right now. And it's interesting that Canada is actually the largest foreign direct investor in Ecuador these days. And we're about to sign a free trade agreement between Ecuador and Canada, which has some interesting effects as well.
I believe that, absolutely. Then also, I just found one question here on my large list. How stable is the power with the grid? I mean, we know also, if somebody tells me in South Africa he's connected to the grid, I say, okay, but that could be still an adventure. So how stable is the grid power in Ecuador? And do you need any backups for your mine project?
Yeah,
maybe, or do you want to do solar power even for the future?
Yeah, so solar doesn't work because of the rainy season. Wind doesn't work; it's too uncertain. So hydroelectric power is the way to go. We will be building a transformer to step up the power so it's more reliable to our project. We will have backup generators as well, diesel generators.
Okay, and that's of course all in the Capex then.
Yes.
Okay, super. Yeah, then, so my list is empty. That is fine. Here, the same thing. Super. We made it. Christian, thank you very much. Great presentation. And as I said, I'm a happy shareholder, and please build the mine. I'm happy with that. If you are taking over $2, I'm also happy. We will see what happens. But definitely there's a lot of upside. And I think the pricings of the analysts with an average of 180 around is more convenient than the stock price today. That's, let's say, 100% potential. And that's exactly how we see it. So fantastic. Thank you very much. And I wish you all the best.
Thank you, Jochen. Take care.
Thank you. Yeah, ladies and gentlemen, that was Christian Kargl-Simard, the CEO of Adventus Mining. And you heard it. This company is a real gem, really fantastic setup, and could be within 2.5 years in production. And I must say, really something like $250 million is absolutely manageable. And as Christian said already, they lined up $240 million for, let's call it a project finance, but non-dilutive. This is really important. They also have enough money to really wait until the project finance, and also with permitting, ESIA, and all those kind of things. It's really progressing. The feasibility study showed fantastic numbers. And I can really urge and advise you have a very, very close look at Adventus Mining, because I think the next weeks, even until Christmas, but probably also the first quarter, will be very, very interesting. And I have a very good feeling that this stock price finally really starts to move. So thanks for watching us, and bye-bye from Switzerland. All the best.
Bye.